Good afternoon. It's Saturday, September 10th, 2022. It's about 1:30 p.m. on the East Coast, and it's a beautiful day. Um, I would like to invite you to please subscribe to my YouTube channel. If you find value in this video or in any of my videos, you can follow me on Twitter at CEO Technician, on co.ca at Goldfinger. My name is Robert Sin, for those that don't know that. I'm an active contributor and blogger on Twitter, co.ca, mainly focused on precious metals and mining, but I'm a trader. I trade lots of different markets, ranging from S&P futures, Treasury bond futures, to individual stocks and junior mining stocks. So I'd appreciate it if you find any value in this. Go ahead and hit the like button, hit the subscribe button, and leave me a comment with your thoughts on this video. Mostly going to cover macro markets, broader markets, and precious metals in this video. I will mention one or two junior mining stocks, both of which I do own shares in. And I'll talk a little bit more about that later. But there's two sort of pieces of wisdom that have been in my mind this week. The first one is there are those that don't know, and there are those that don't know they don't know. And usually it's the latter that are more dangerous, right? There's so much information to digest in the world today. Markets and economies are very difficult to analyze and forecast. There's so many moving parts. There's so many things that are unpredictable, unforeseeable, that occur on a regular basis. And so it's very important that we keep an open mind and don't get too stuck in one way of thinking. Um, and then the second one is that when it's the time to buy, you won't want to. And um, those two have a lot to do with one another, especially in markets. Very often at key turning points, the sentiment of the crowd tends to lag. So, for example, when a market starts to roll over from a major top, it starts making lower highs and lower lows. The crowd, the herd, tends to stay long. They tend to stay too bullish for too long, even as the evidence starts to mount that things are turning south, right? And the same thing can happen at bottoms, at major bottoms. The crowd tends to stay bearish for too long. They tend to stay stuck in the past. And, oh, well, markets are down 20% or 30% for the year or whatever it may be. And then when stocks start to make higher lows and higher highs and start to move up, they don't get aboard until much, much later in the rally. So those are just two thoughts to start off this video. And then I do want to talk about sentiment. So um, sentiment is very negative right now on pretty much everything in financial markets. And you can see this survey, the AAII sentiment survey, in the last several weeks, it's gotten increasingly negative. So in mid-August, and that was after about a 6-week bounce in stocks, in mid-August, the number of bulls and bears were about even, almost at the same level. But since then, the number of bears has increased a lot and the number of bulls has dropped to the point where now, according to this survey that was put out last week by AAII, it's basically 3-1 bears versus bulls. This is probably the most negative sentiment survey I've seen from AAII. I'm not saying it is, but I can't recall one that was more skewed to the bearish side than this one. And there's a lot of other surveys that I look at and gauges of sentiment that sort of confirm this, that first week of September, investors were extremely negative, and the daily sentiment index on the S&P was down to, I don't know what the exact low was, but it was around 12 or 13. That's a pretty extreme low reading for the biggest stock index in the world. Talking about gold and silver, which lately have had a reasonably high correlation to the stock market in 2022. Gold and silver both reached single digits on the daily sentiment index last week. So a 9 reading for gold and silver at the recent low, right? So people are very negative, and a lot of that has to do with the recency bias, the fact that gold and silver are down in 2022. The stock market is down in 2022. So people have been losing money being long these things. And so they're very negative. Um, on September 1st, I published this blog post on CEO.ca talking about a major low in precious metals is imminent based upon a multitude of data that I look at. The daily sentiment index is one of them, but also the COT data from the CFTC has showed now that the commercials, so people that are usually the large market participants in futures markets that are usually short silver and gold. They're usually short. They could be major mining companies that are hedging their mine output or what have you. They're usually short. Well, in silver, they turned long 2 weeks ago. So let's call it 10 days ago. They flipped to a small net long and then confirmed even further with yesterday's data from the CFTC showing that the commercials are now net long more than 5,000 contracts in silver. So basically a net notional long in silver of about $500 million. That's substantial, and that's something that we don't see very often. In fact, it's only happened 3 times previously in history, and all 3 were near key turning points, major lows in gold and silver. So the last time it happened was in May of 2019. You can see this little red arrow on this chart. That was the last time that the commercials flipped to net long in silver, and we got a very nice lift over the next several months in silver, rallying from under $15 an ounce to nearly $20 an ounce in 3 months. So we have a similar situation to today, and there's even more uh, signs. There's more evidence of extreme negative sentiment, including um, the Sprott Gold Trust, the physical gold trust, trading at a discount of about 2% a couple weeks ago. Just basically a complete sentiment washout in precious metals and stocks in the last couple of weeks. We go back to 2018, the last time the daily sentiment index for both gold and silver, so not just one, both went into single digits. This is where it happened. And that turned out to be a major low and a very key turning point in precious metals. So that was a blog post I wrote 9 days ago. And then last week I published this when it's the time to buy you what want to, starting to talk about the venture composite in Canada, which is mostly junior miners, a good proxy for the junior mining sector, how we're just sitting barely above major long-term support level here dating back to 2018 and 2019. The sentiment on junior miners is even worse than it is on the broader stock market. It's extremely negative, among the most negative periods of sentiment I've ever experienced. And then I went to talk about an individual junior that I think is very interesting and at a very low valuation right now. So if you're interested in that, you can read that article. So moving on, broader stock market. So we have extreme negative sentiment, and the S&P rallied last week. It was actually up. So last weekend, it felt like there was another shoe that was about to drop. And most of the market commentators that I read over the weekend, the Labor Day weekend, 3-day weekend, were bearish. And they were figuring that stocks would be down last week, they would fall further. And look at what happened. We turned up. And I don't think there's any easy explanation for why stocks rally, but you don't really need a narrative when sentiment is this negative. Just people are really negative. And from experience, we know that when everybody is leaning short, everybody's in cash, stocks just tend to find an excuse to rally. And maybe that excuse could be that inflation is easing, the Fed is starting to accomplish its goals, and maybe we're going to get confirmation of that this coming Tuesday and Wednesday when we get the CPI for August and the PPI for August. So maybe we'll rally couple more days, heading into those data prints, and then it would be a sell on the news. I don't know. I don't have a forecast for it, but I do know that when so many people are as negative as they are, the path of least resistance is most likely going to be up, just to frustrate the crowd. Maybe the S&P can rally up to 4150 or maybe even 4200 next week. Sentiment will flip to the bullish side again, and then we'll go back down. It is notable, though, and this is something I talked about the last couple of weeks, that most likely this inflation data we're going to get for August is going to be uh, sort of what the market wants to see, what the Fed wants to see. There's a lot of evidence. There was a lot of drops in prices across the global economy in August, whether you look at the Baltic Dry Index, which is basically the cost of shipping across the world. Gasoline prices dropped a lot in August. I booked some travel at the end of August to go to a couple of conferences, and it was notable to me. I mean, I could notice the price drops in car rentals, in hotels, and even in airline tickets, right? And back in May and June, we were all complaining about the price of car rentals, airline tickets, gasoline prices, right? So there's a lot of evidence that prices are cooling. So inflation is cooling across the economy. Um, and the supply chain pressures that were such a big part of the consumer price inflation that we've seen in 2021 and 2022, those are easing, those are abating, right? So there is a little bit of good news out there if you look for it. In the sea of overwhelming negativity, there is some good news. And again, this is not me making a forecast, but just as a technical analyst, every bottom, every confirmed bottom starts with a higher low. So if we look at the S&P chart, the low so far was in June, sort of this waterfall crash in June. And we rallied again against this backdrop of negative sentiment, extreme negativity among market participants, and headlines dropped back down and now turning up. So this is a higher low. You could say that's the low. That was a higher low. This is another higher low. So obviously, we need more evidence, and most likely this is going to stay messy for the rest of the year, where we could be trading in a range, but it's constructive. We're making higher lows. These are just some levels in my shorter term 30-minute chart of S&P futures. But yeah, the big purple line, that would be sort of my upside target in the event that we rally further in the next week or two. That's a big level. And you can see that's a level that we rolled over from on August 26th. One of the things that I mentioned in last weekend's video was the NIMO, right? So this oscillator, uh, it tagged a negative 101 reading, not last week, but the week prior. So the first week of September. Um, and we've rebounded back to the, neutral line, right? Very often when the NIMO reaches a negative 100 reading, that's a pretty big oversold indicator and a buying opportunity in the near term. And sure enough, that proved to hold true again this time. Again, rally in small caps and stocks at the end of last week, 3 days in a row to end the week. And we're back above in the IWM, the Russell 2000, we're back above a rising 50-day moving average. Very similar chart, obviously, to the S&P. Some individual stocks that performed really well on Friday. Caterpillar. So this is interesting. It gapped higher, rallied throughout the session, ended the session up 3.46%. That is interesting. That is really notable. I would say Caterpillar is a very economically sensitive company and stock, and has been dealing with a lot of headwinds in 2022. Whether it's the Fed raising interest rates or China having all these zero COVID lockdowns. There's a lot of headwinds out there, but they were buying Caterpillar at the end of last week. So that's something to keep an eye on in the week ahead. And definitely a positive sign if you're actually trying to look for positives out there. I would say the price action in Caterpillar at the end of last week is a notable positive sign. And then I think we just have a bunch of short squeezes playing out. Stocks like Coinbase and AMC. So these are the more heavily shorted meme stocks, high beta, where they can drop 10% or rally 10% on any given day. Well, they were in short squeeze mode at the end of last week, and Coinbase up over 10%. And from a technical standpoint, you could draw a bit of a rounding bottom here. You have the makings of a chart pattern bottom in a stock like Coinbase that has been so beaten down since last November. Again, this was nearly $400 a share in 2021. Well, it dropped into the 40s back in May and June. It's doubled since then. So yeah, it had a massive drop, basically almost 90% from high to low. But one has to wonder, did that big, decline price in all the bad news? And is Coinbase now bottoming? That's a question that I would throw out there. AMC, you could make a similar story, as Coinbase. Not a fan of the fundamentals here or the CEO, but it is notable that it had such a big rally on Friday. And I think that this is more evidence that we're seeing a bit of a short squeeze play out here in stocks. So turning to some more macro factors like Treasury bond yields, I think this is important to keep an eye on Treasury bonds, on yields, and on the US dollar, right? So the 30-year uh, Treasury yield bumping up on a big level, 3.5%. And that's a big round number level. And it's also an important level going back to late 2018. So if we think back to late 2018, where the 30-year peaked out at around 3.5% and then went on um, this big drop over the next year, to a year and a half into early 2020, and the whole COVID crash and panic. Um, at the end of 2018, so Q4 2018, that was a time when the market was in quite a bit of turmoil, and the Fed, so Powell, in his first year as Fed chairman, made a significant pivot where they were talking about raising rates further, and then suddenly they weren't, because stocks were trading so poorly. Markets were not enjoying the prospect of the Fed tightening further at the end of 2018. And they ended up pausing. And then the Fed actually ended up cutting interest rates in 2019, right? And that was sort of a key turning point. So that was bullish for stocks. Stocks bottomed in the final weeks of 2018 and had quite a good year in 2019. That was also kind of a key turning point for precious metals. Uh, Gold actually bottomed in summer of 2018 at 1167 an ounce, and proceeded to make higher highs and higher lows throughout the rest of 2018. And then we know that when the Fed actually did cut rates in 2019, gold and silver went on a big run throughout the summer of 2019. And then obviously 2020 was a whole different story. But here we are again at this 3.5% level on the 30-year yield. We're very close to it. We're not exactly at it. Ended last week at 3.45%. But this is a big level. This is a big level. And the Fed is talking about raising rates, the Fed funds rate, 75 basis points at their next, meeting in 10 days. And then the market is also expecting further rate increases at the subsequent two meetings, the last two meetings of the year. And in fact, Goldman Sachs read the Wall Street Journal. The chief economist for Goldman Sachs got his cues quite clearly from a Wall Street Journal article that came out last week, basically expecting 75, 50, and then 25 at the next three meetings. So that would bring the Fed funds rate to 4% essentially at the end of this year. We want to watch how the long end of the yield curve responds to these next Fed rate hikes. If the 30-year yield starts to roll over to the downside, I think that would be a sign, a very strong piece of evidence from markets, the bond market, that that's going to be it from the Fed, and that inflation is rolling over and the economy is weakening, right? And that would basically imply that the Fed is done. There's no more tightening, at least not in terms of rate increases. And then the conversation would become, when is the pivot coming? So when are they actually going to cut again, right? Some point in 2023, right? And that will be the conversation. It's clear there's no cuts coming in 2022 or even in the first few months of 2023, but the market is forward looking. The market will be looking ahead, and it will, it will get, we will, as market participants, get our clues from the yield curve and what the bond market is doing. And so this is something that we want to really watch over the coming weeks and months. And notice that I put this correlation down here. So the correlation between the 30-year yield and the S&P 500, when it reaches a pretty strong negative correlation, like negative zero point 0.7 or more, like in 2015, at the end of 2019, and right now, that has often been sort of a turning point where there was an inflection, that was about to take place. Um, and so we have to keep an eye on, is there about to be an inflection taking place where the short end of the curve is pushed up by the Fed funds rate going up to 4%, but the long end of the curve, so long end rates, start to move down, creating more of an inversion where the front end rates are higher than long end rates. And a deeper inversion in the yield curve is a sign of a weak economy or an economy that's in a recession, and that would quite likely be a positive for precious metals, gold and silver. Okay, so that's something that we do want to keep an eye on here. This is my ZB, so this is 30-year Treasury bond futures, 30-minute chart. So this is a chart that I use to trade from sometimes, and just showing the makings of a head and shoulders bottom. Now, this needs confirmation. We have not broken out above the neckline, but the pattern is forming. And something that I'm going to be looking for, especially when the Fed does raise rates at the next, meeting in 10 days, is how does the Treasury bond market trade, and will long end bonds, the ZB, actually rally on the rate hike that, in sort of a sign that it's been priced in. We've reached peak hawkishness from the Fed, and the market is now looking forward at falling inflation, um, a softening economy, and a Fed that is going to be just a little less hawkish than they've been in the last couple months. Okay, so this is just something to keep an eye on, something to make note of. And, with people so hawkish and so negative on bonds, it has the makings of a bottom. Euro, US dollar. So the biggest currency pair in the world. This has been in a substantial downtrend in 2022. The euro dollar broke through parity in the last couple of weeks several times, but it ended last week just above the 1.00 levels at 1.0043. And, you go on Twitter, you read any financial news, and there's so much about the Eurozone, the EU, with this energy crisis, um, and how, they're going to have to ration energy this winter. Um, just a rampant speculation about how bad things are in the Eurozone. Uh, but look at the chart. The euro has been beaten down all year long, and it's extremely oversold, but starting to show some signs of bottoming around this parity level. And so this is something that we also want to keep an eye on, because the sentiment is extremely negative on the euro. It's extremely bullish and positive on the US dollar. And it's at the sort of extremes in terms of sentiment that it's fertile ground for a turning point. It's fertile ground for these markets to switch a bit, and the euro to rally and the dollar to actually, decline against the euro. But we'll have to see. We'll have to see. And the strong dollar definitely has served to keep inflation somewhat in check in the US in 2022. But I'm sure the Fed does not want the dollar to be too strong. And one has to ask the question, is it starting to get to the point where it is too strong? Um, this is a chart of the week from Haywood, broker in Canada. Basically, gold does well during periods when the S&P is not doing well. And since 1972, when the S&P has dropped 20%, or in that neighborhood, around 20% from its peak, gold has only declined once during those 7 periods. And the decline was actually very small, less than 1%. And the average gain for gold is 28%, from a low of 6% to a high of plus 137%. So um, during stock market downturns, gold has a history of actually outperforming and doing quite well. So the gold weekly chart, putting on my technical analyst hat, just quite frankly, we can see the 200-week moving average is upward sloping, longer term. That is evidence of an uptrend, but the price has pulled back almost all the way to this 200-week moving average. It's also notable that the 200-week moving average is currently coming in at 1677. Now, that's obviously a dynamic number. It's a moving average by definition. It's changing, but it's coming in right now at 1677, which happens to coincide with a major level of support. If we look to the left on the chart, since the beginning of 2021, gold has come down to this, let's call it 1675 to 1680 level on at least 4 different occasions, and it proved to be support each time. Now, one of the sort of rules, tried and true tenets of technical analysis is the more times a level is tested, the more likely it is to break. So if it's been tested 4 times in the last 18 months or thereabouts, uh, what will happen if it's tested a 5th time or a 6th time, right? If you're a gold bull, you don't want to find out. You don't want to see this level tested again. Definitely not 2 more times, because the more often it's tested, the more times it's tested, the more likely it is to break. So, from a technical standpoint, I don't want to see gold going back down to 1680 here in the next few weeks. Obviously, not rocket science. The better outcome would be to see gold start to move up right now, and move back up above 1800 in the next several weeks. The more time that gold spends down at 1700, moving aimlessly around 1700, the more likely it is about to break down to a new low. So this is something that we want to be mindful of and keep an eye on. The longer term trends, whether it's the weekly, the monthly, are all up. Gold is in an uptrend longer term, but in the short term, gold has been in a downtrend. And so now these different time frames, the daily time frame, the downtrend in 2022 is sort of coming to an intersection with the longer term uptrend. And it's usually at this sort of an intersection of time frames that uh, a turning point you know is going to happen. So either we're going to move back up, and gold is going to prove again that it is in an uptrend longer term, or something's about to change. And so this is an important time. This is an important next couple of months for a lot of markets, including precious metals. um, Gold. So this is again the 30-minute chart, and yeah. So this was so September 1st. This test down to 1700 in the gold futures so far is proving to be a low, a short-term low. But in order to have any confidence that that really was a major low, I think we need to break above this level. So minimum, we need to move back above 1740, and preferably have a weekly close above 1740 to sort of add weight that that was an important low in gold. Silver is the one that uh, has the big inflection point in the COT data, with the commercials moving to a net long stance. Silver, it seems like it's even stronger than gold last week. And silver made a major low on that September 1st day at 1740. Uh, we got up almost to $19 on Friday. The high of the session was 1886. Something that we want to keep an eye on here is the downward sloping 50-day moving average. So that's coming in around 1920. We would really want to see a weekly close above 1950 to add confidence that 1740 was a major low, but it does, based upon a multitude of factors, feel like that 1740 level was a major washout low in silver. And since gold and silver tend to have a pretty strong correlation to one another, it adds weight that the low could be in for gold. Another thing that I look at in the chart is the relative strength index. And silver got extremely oversold here in the middle of the summer, down around $18 an ounce. You can see the RSI got down to nearly negative to the 20 level. Well, at the lower low on September 1st at 1740, the RSI did not really get under 30. It got to 30, and then we've bounced since then. So that is what's called a bullish divergence on the RSI. So the selling momentum is weakening, even though price made that lower low. So that's adding some evidence that that was a washout low, that this market is just completely oversold and ready to turn up. Um, so yeah, there are a lot of factors coinciding in terms of sentiment and technicals, and maybe even a little bit of the macro, if you want to throw in there the idea that the dollar could be at a turning point and the Fed has reached peak hawkishness. That doesn't mean that they're not still hawkish. They're just going to become less hawkish going forward. Prices, the market is made on the margin. It's made on the margin. So less hawkish, but still hawkish could be better for precious metals. So here's the COT chart showing the commercials in silver, the red line here moving net long, just like they did in May of 2019. And you can see what happened after that. One thing to note, though, is that in 2018, you can see the red line moved net long for several weeks in a row, and the silver price just sort of bounced along the bottom for several weeks. So that doesn't mean that silver has to go straight up like it did in the summer of 2019. It can also just sort of oscillate, gyrate, bounce around a bottom, but not really make a new low for several weeks in a row. Gold, um, yeah, you can see that obviously the red line is getting smaller, it's getting less negative, but still in negative territory. But the speculators, the green and blue line, are getting less long in gold. And that's usually what we see in downtrends. The open interest in futures gets smaller, less interest in the market, and the CTAs and the hedge funds start to move to a net short, like we have right now. They're basically trend following the price lower, but that adds fuel for further upside in the event that a rally does start. They will all start to cover their shorts and then maybe even start to go long again. So the GDX, the gold miners, rallied just like the broader stock market in the final 3 days. Last week, the GDX was up 3%. The junior gold miners were up 4%. So a very nice end to the week. And again, I think this is just combination of short covering and rallying from deeply oversold levels uh, against negative sentiment extreme. So again, just sort of markets uh, generating the maximum pain by rallying when everybody's in cash or short. If we, just like the silver chart, we want to look at this falling 50-day moving average next week. If we do get further upside, that's probably going to be the first level where we see a little bit of a pullback start to take place up around 2580 to 26 on the GDX, or around the 3150 to 32 level in the junior gold miners. And then AEM. So this is one of the largest gold miners in the world. Um, we have the makings of a higher low. So every bottom, like I said earlier in the video, every market bottom, every chart bottom starts with a higher low amid really pervasive negative sentiment. And the AEM chart is just one example of many I could choose from in the gold space. We have those conditions present where the sector is widely hated. The earnings that the sector, reported last quarter were widely, um, you know, panned as being really negative, terrible quarters from across the gold and silver mining sectors. So we have this pervasive, negativity, a widely hated sector of the stock market, and we've got our first higher low, and prices are starting ever so slightly to turn up, like we saw last week. Core, this is a silver mine. I mean, they generate both gold and silver, but mainly thought to be a silver miner. Uh, the makings of a double bottom, maybe. And this stock has been obliterated at some point. At one point in 2021, it was $10 a share, reached a recent low near 250, so down 75% from its 2021 peak. It's been obliterated. Obviously, anybody can see the downtrend here, but just like I said at the start of the video, when it's the time to buy, you won't want to, and every bottom starts with a higher low or a double bottom. And then AG, this is a pretty popular silver miner out there. The makings of a head and shoulders bottom, left shoulder, head, right shoulder. And then you can draw the neckline either horizontal around the 850 level, or you could draw a slanted one from these peaks here. Either way, it has the makings of a head and shoulders bottom. Uh, the recent low, September 1st, was a higher low, relative to this one, and the relative strength has actually moved into positive territory. So there are some positive signs here in the AG chart. And there's a lot of examples of gold and silver miners where they are starting to form chart pattern bottoms. They have the makings of a bottoming process taking hold here. And now we just need to light that fuse to have the rally off of the confirmed chart pattern bottom. So I will wrap up this video talking about Junior Gold Explorer that I own. Okay, this is endurance gold, so you can consider me talking my book. I'm biased, of course, but I think this is a very interesting story and one worth taking a closer look at. So they have the Reliance Gold project in BC, Canada. Um, you can see the different zones, okay, all based upon this shear zone called the Royal Shear Zone. And they've drilled out these three zones. Right now, they're focused at the Eagle South zone. And they've, defined this trend that's 1,500 meters long and actually being extended right now because they're drilling to the southeast here in this area. So if we flip through the slides, you can see some of the drill intersections that they've reported. So at the Eagle South zone, they have, many high grade gold intersections, including 15.7 grams gold over 24.8 meters, 8.62 grams per ton gold over 24.4 meters. And then further up here, they've got 5.89 grams over 31.5 meters. But this is mineralized high grade gold, and they've got a lot of hits. So looking down at the drilling stats, they have a really good slide I want to show. You can see really high hit rate, 25 of 32 total, drill holes have, significant gold intersections, including 7 out of 32 have excellent ones. So something like a 15.7 grams over 24.8 meters, which is frankly, world class. So very high hit rate. And quite frankly, you don't see many gold explorers with this high of a hit rate. With these sorts of grades very often. So scrolling down here to this slide. So this is the current drilling. So they're at the Eagle South Zone, and they are drilling it, extending it along strike and at depth to the southeast. So this zone, this is the one of the 3 zones on that first map that I showed. It's 450 meters strike length. It's about 150 meters width, and they're extending it to the southeast. So I don't know how far they're going to be able to extend it, but I guess we will find out over the coming months. But obviously, they could extend it to 500 meters, to 600 meters, to 700 meters, obviously, with more drilling to prove that the gold zones extend that far, right? And then to extend it along strike or width is one thing, but then to extend it to depth. And with this sort of gold system that they have, at the Reliance project, it's an orogenic gold system similar to the Fosterville mine in Australia. And the thing, with these orogenic gold systems is that they can go very deep, and very often the gold grades get better at depth. So that's something that we will see with the results that the company will continue to generate with further drilling. This diagram of their model is instructive because it shows basically 4 vein zones. They've named the first 2 ones the 024 vein zone and the 027 vein zone. I'm not sure what these 2 will be named, but you have this basically 150 meter wide, 450 meter long so far area with 4 vein zones. So you can sort of do your calculations if the vein zones average 10 meters width, and then you can calculate an average grade and sort of do a rough calculation what they've defined to date. But the key thing is that with further drilling, it can get bigger. It can grow along strike, then it can grow to depth. And so that's what Endurance is working to prove out, right, by drilling to the southeast right now. So the 024 vein, which is this first one, is up to 52 meters wide. And then they show different picks of core from different areas at the Eagle South Zone. And it's very interesting. This was put out in the most recent news here. What I found interesting about the news they put out on September 6th last week was, again, high hit rate. They reported, let's see, they reported these holes. So I believe 3 holes, 3 or 4 holes, and they were all had high grade. So 14 meters of 4.37 grams per ton, and 11.9 meters of 7.58 grams per ton. And sort of their low grade hit was 15.2 meters of 2.13 grams per ton. Also, the comments about holes 35 through 38 were very interesting. Basically, southeast of these reported gold intersections, encouraging zones have been intersected in drill core from holes 35 through 38. Um, and then in the CEO's quote, again, uh, observation of additional, intersections at depth give encouragement that we are confirming a robust gold system, right? So, couple of hints in this news that was put out last week that things are looking good in holes 35 through 38, and they've decided to expand the drilling to the southeast. So this is an interesting one. Again, I own a significant number of shares in this company. You can consider me biased. And this is probably one of the most interesting gold explorers that I've come across in the last couple of years in the junior mining sector. So worth taking a closer look at. And then you can see their sort of final slide in the updated presentation. Um, Now over 450 meters and open, new feeder targets at Eagle South has opened up the depth potential. So that's it for me this weekend. I hope you guys have a great weekend. And again, please like and subscribe to my YouTube channel and follow me on Twitter at CEO Technician.